we are at one of the better markets in the country. And so it is a matter of time before we bounce back. We'll bounce back quicker and everything will shoot back up again.
Yeah. If you take out, by the end of this year, if you take out 2018, which we have to look back, that was a phenomenal year, 21 and 22. So just those 3 years, I actually think in our careers, this will end up being the fourth best investment sale year by volume in our career.
Welcome to our Industrial Advisors podcast. You have Bill Condon and Matt McGregor. And today's topic, going through our Q3 review. We just got our numbers and stats in, and so been an interesting quarter.
Really interesting quarter. We were talking about it before the show started, and it's kind of strange because you think back 2008, the downturn of 2008 through, we started recovering in 11, where vacancy started going down. And we just looked at this. The vacancy currently is about the same, a little higher at 9.2 in the Valley. So the worst of that downturn was 9.1.
In 2008. Or 2010. 2010.
So obviously the market hit in 2008 with the downturn.
Yeah.
But if you recall, Seattle was the slowest to be hit and the quickest to recover. So it was actually a shorter window than what it was nationally. Nationally, it was like 5 years. Here it was about 3. But it took until 09 to really hit. You started seeing it in 08. Took 09, and then 010 was the depths of it at 9.1% vacant. We're currently 8.9, but the Valley is 9.2. So if you include, obviously, Everett and the North End, but arguably across the board, we are at the same as the worst vacancy of our career in 2010. Why doesn't it feel like that? It doesn't feel like that.
Well, I think the market's grown up since then from a standpoint of there's more bigger markets, more tenants. So there feels like there's more action because it's a bigger market.
Yeah.
I do remember in 2010 doing a deal for 50,000 feet at 29 cents on the shell.
I remember that.
Yes. Which is just crazy to even think about.
Triple nets are higher.
Yeah, today's market. But yeah, I think the market's grown up since then and been built out more. And so because the depth of tenants is larger, there's more action than there was then, even though it's slow today.
I would agree with that. And I would add that I feel like when it happened then, it was sudden. It was like somebody turned off the spigot for about a year.
Yeah.
And I remember like the phone not ringing and it being deathly quiet, like email box, like it hit the country. And then I was going, what's everybody complaining about nationally?
Yeah.
And then like 6 months later, I remember in November of 08, it was like, wow, now I know what everybody was talking about, right?
Yeah, well, and if we'll talk about this later, but from an investment standpoint, during that really quiet time in 2000, like that 10 era, there was like, you could count buyers on one hand.
Yeah.
That would even look at anything. Yes.
Sometimes it was Bert.
Correct, yeah. And right. So there was just caution everywhere on the investment side.
Yes.
And
we're not there.
No,
not even.
No. Now there's plenty of investors out there right now.
So you're right. A healthy, and we'll get to that, a healthy investment market. But then to my point earlier, this is taking 2.5, 3 years to go from a high 3 vacancy to what it is, where really it went from a tight market then to a terrible market in about a 12-month time span.
Yeah.
Right?
Yeah.
Where we've just been slowly going into it, right?
Right.
But there's a lot of healthy aspects.
Yes, there is. Yeah. So let's talk about some of the major themes that we're seeing.
Yes.
Number one, I think renewals are a big part of the market right now. When in doubt, I think the majority of action that we're seeing right now are renewals and not relocations from tenants.
Yeah, and truthfully, obviously to prepare for this show, we call landlords, we call investors, we call tenants, get opinions.
Yeah.
Landlords are all talking about renewals. That's what they're seeing, not a lot of new deals. And obviously we'll get there on, no surprise that negative absorption, but a lot of renewals.
Yeah, and within those renewals, if you take it a step further, landlords are more flexible on term, on doing things that they would not do in a healthy market.
Yeah.
You want to renew for 2 years and you want $2 a foot, we'll do it. We'll keep you there.
Taking worse credit than they normally would.
Yeah, exactly.
Yeah.
Just because from a vacancy standpoint, they're weighing credit risk versus if I have to go find a new tenant, it's probably going to be vacant anyway.
Yes.
Right. So for a while. So yes, they're taking more risk on the credit side.
That's right. And then speaking of credit, that was our second kind of theme of the market this quarter and this year, third quarter, is credit risks and tariffs really starting to turn up what we're seeing in obviously vacancies, but bankruptcies. We've had several big bankruptcies this year. We talked to a major landlord in preparation for this that's talking about a couple more. I won't throw names out there, but certainly smaller 3PLs that were retail focused, mostly if the majority of their contracts were a major retailer with tariffs, consumer confidence, consumer spending is changing. And, if you're a one-trick pony on the 3PL, you're at credit risk.
Yeah, for sure. And so that's something landlords are constantly weighing in today's environment. Some positive news. I mean, South Seattle struggled for years now, and there's been a little bit of rebound in that market for Q3. Vacancy's actually gone down.
70 bips.
Yeah.
Yeah. So that is really the I would say out of all the markets, the biggest change, right?
Yeah.
South Seattle, we've been unfortunately beating it up on many podcasts. We can now say it's improved. Things are improving. I would even say the homeless situation down there, when you drive down there, is improving. But overall, vacancy's down 70 bips.
When you look at that, I think, there is still a challenge with that market, but good news from a standpoint of vacancy came down.
Yeah, and you're right on the challenge, and we can just touch base on this. I did on track 6. They're about 30% occupied, but I understand there's 2 deals that look imminent that would bring them to about 60% at least, and that's, I believe, if not the longest, one of the longer term vacancies in South Seattle is the multi-story.
Yeah.
And it's not just track 6, it's others. Horton's still struggling with 0% vacancy, and then the Trammell Crow building with 0% vacancy.
Yeah. Just drive by that building the other day. It's nice.
Yeah. Beautiful building, just needs a tenant.
So we are going to jump into the vacancy rates by submarkets and then talk about the different size sectors as well. So just quickly going through, South Seattle close in is 9.3% currently vacant.
Down from 10.
Down from 10. So that's good to get into the
Single digits.
Kent Valley is at 9.2. That's up from 8.6 last quarter. Pierce County is at 9.9. That's a jump from 9% last quarter.
Due to deliveries.
Correct. Yes.
But now replacing Seattle is the worst vacancy.
Yeah, but 2 big buildings lease up there, and all of a sudden...
and one is at,
yeah,
I think, so we're going to see a big one removed. That'll drop back down quickly.
Yeah, that'll move the needle.
Yeah.
And then Thurston County's stayed pretty consistent, 5.3%. So when you exclude the north end, you're about 9.2 in those submarkets that we just went over, up from 8.8 the previous quarter. And then you look at the east side and north end real quick, they stayed pretty consistent, 6.3% on the east side vacancy, north end's 8.2.
That's right. And then let's go to sizes. Same theme we've been talking about all year. Let's play small ball, right?
Yeah.
10 to 25, 4.5%. And as you go up in size, you go up in vacancy.
Yep.
Until you get really big. 25 to 50, 4.7. So both of those still a landlord market. Then we switch to a tenant market, 50 to 100, 7.4. The continuing theme, which is unfortunately jumping up in vacancy again, 1 to 200, because we had last quarter, remember, we had some positive absorption, and now we got negative again. So 1 to 200, 12.7%. We got a couple years extra inventory there. That's just been brutal.
Yeah, that's been a tough size mark. It's a tough size range that landlords are really starting to get aggressive in.
Yes.
Unless you can do something unique and break a building up or do something different.
That's right. And then the biggest increase in vacancy was above 200, but that's because of deliveries. You had about a full 100 basis point jump in that, but that's because you're starting to now deliver some big boxes.
Yeah, that's exactly right. So some of the largest move-ins, just a couple to note, Amazon, at least a couple 100,000 square feet in South Seattle.
And Goodwill and Flying Food Group. Those are the 3 biggest. And none of those were huge. Amazon was pretty good size.
Yeah. What was the total on Amazon?
230.
5 or something?
230, yeah. It was Emerald Gateway, Prologis.
Yeah, so you mentioned absorption. We were negative 550,000 square feet in Q3. So that puts us at year-to-date negative 1.4 million for the market wide.
Yeah, let's pause there and say predictions for Q4 on that. So we're negative 1.4, which is worst year, man, and we should have prepared for this, but I'm going to guess it's the worst absorption year in over 10 years, maybe since 2010 or 11.
Yeah, I mean, we've been positive for so many
I
years
think
in a
11
row.
we started recovering, so you would say we definitely had positive absorption from 11 on, so it should be since 2010.
Yep. Yeah, again, more developments
So
in today's
15
environment
years.
than 10, 15 years ago. But
Yeah.
but yeah, that's
Yeah.
part of it and comes back quick. So what do I think in the fourth quarter? I think that if there's a big deal or two that gets inked, awesome, that'll help with those numbers. But I think we're going to be relatively flat over the Q4, and hopefully there will be a big deal or two that gets done, and then we head into 2026 with some momentum.
And this is rare because you are Mr. Positive. I'm going to actually say that we're going to cut this at the end of the year down to a negative about 400,000 feet. And I'm banking on
Correct.
a major deal happening.
Yeah, I mean, that's what it takes, right?
Yeah.
But we do need, and we've talked about this a lot over the years, you can tell a lot about a market by what's going on in the mid-size range,
Yeah.
right? So call it 50 to 150, right?
Which is not great.
Right. I mean, that's the fundamentals of what the Kent Valley kind of plays in, right? So we need to get that market back, and then the big box, that'll come, and then if we can get that mid-market to come back, then everything follows.
That's right. Let's talk about investment sales. That, as you pointed out in the beginning of this podcast, it's the one thing that just is going super strong. We're at almost 1.3 billion in sales, already topping last year with what arguably normally is the best quarter of the year going into Q4.
Yeah.
So no question, we're already beating last year, and you minus COVID, and we are above average with a quarter to go, which is just huge.
Yeah, and there's some product out there. I mean, we're selling some stuff that'll trade in Q4. So the investment demand is real.
It's real.
You look at it from a historical standpoint, obviously with where the vacancy rates are today, investors are buying buildings at a basis they feel really, really good about.
Yeah,
And
for sure.
I do think that
$80 a foot down, maybe 100 down from the top of the market.
I mean, you look at it, this is going to be an era, I think, where investors look, if they're buying in the core markets in the Puget Sound, they're buying a building that they believe in, they're going to look back 2, 3, 4 years from now and be like, that was a fantastic basis.
That's right.
And so we are at one of the better markets in the country. And so it is a matter of time before we bounce back. We'll bounce back quicker, and everything will shoot back up again.
Yeah. If you take out, by the end of this year, if you take out 2018, which we have to look back, that was a phenomenal year, 21 and 22. So just those 3 years,
Yeah.
I actually think in our careers, this will end up being the fourth best investment sale year by volume in our career. And again, you just take out those 3 years.
Yeah, so healthy market for sure. I think part of that too is investors are focused on, markets that nationwide have good fundamentals, and we're certainly one of those.
Yeah. And land is going crazy. I mean, obviously
land's a good, if you can go.
We've got the UP side out, and it's phenomenal.
Well, think about it. I mean, if you're a developer, right, and you're looking at a site and you're thinking that's going to be in production in the next couple of years.
Yep.
Time for the market to recover.
For sure.
You're buying it in a really, really good market. It makes a lot of sense to be looking at land right
Yeah, way down from the top of the market, and to your point, that's not going to be a development, probably for 3 years.
Yeah,
right?
yeah. So I get it.
Yeah.
Yeah. So really, just kind of looking at Q3 and recapping what we just discussed. We think a lot of Q4 will have a lot of renewals still. Maybe a big deal or two that inks.
At least one big deal that hopefully hits that absorption. Of course, I made that prediction. I didn't think about some of the deliveries, so that'll throw that off because we are delivering. I mean, we're delivering the golf course. Yeah. Right. So that might throw my numbers off a little bit.
Well, maybe we lease them. Who knows? Yeah. Yeah.
And obviously, Bridge is delivering a couple billions as well.
Yeah. But we'll see. Credit is obviously going to continue to be a big, and how investors look at credit will be big going forward. Mm-hmm. That's always big. And then South Seattle and some of those other submarkets, we'll see how those continue, if they continue to progress or hit kind of equilibrium again. And
then the final big prediction, Mariners are hitting the playoffs for the first time since 2001.
They won the West, and it was the last time they won the West was in 2001. So, yeah, it's been a while. They've never been to a World Series. We're going to beat the Phillies in the World Series is what's going to happen.
We're going to beat the Phillies.
We're going to beat the Phillies in the World
prediction.
Series. Yeah.
Okay, excellent.
Yeah. And don't forget about the Seahawks at 3-1 right now too.
Okay, well, the listeners are going to be listening to this on Friday. Saturday is the first Mariner game.
Yeah.
And then are we having Sunday Night Football?
No, we don't know yet.
We don't know yet.
We don't know that. The MLB gets priority over the NFL, so they're going to name the Mariners time, and then the NFL might push the Hawks back a little bit.
I think the Hawks are getting a lot of publicity right now. Right.
They should be.
And then Tampa Bay is a very popular team.
Yeah.
I would think that'd be a good Sunday night football.
Yeah, I don't know if they can
calling
flex
it now, Sunday night.
Yeah, maybe. I don't know if they can flex it or not. We'll see. Mariners are winning the World Series. How about that?
Yes, love it. Happy Friday, and let's go Q4.
Yep.